Hey traders, welcome to Charts and Coffee. Happy Monday, everybody. Hope everyone's had a great weekend, ready for another, hopefully calmer, less erratic, less pushing standard deviations kind of week. We get back into that 68% normal range that we've been dealing with for months. We'll see. That's going to be the big question as we have a lot of FOMC members speaking today. Let's jump on over there. Let's see. So there's a couple different calendars you can look at. A lot of questions sometimes come up around. All right, Rog, in the morning, what are you looking at? I'll look at a little bit of the action from about 7 a.m. on. We can see what happened at the 4 a.m. Asian close. But at the end of the day, we deal with what's going to be happening for the most part 9:30 forward. So if we jump on over to, okay, this is Forex Factory. Here we go. So if we jump on over to Forex Factory, you'll see today we've got 8:30 core retail sales. So that's something we'll be dealing with the aftermath of. Empire State Manufacturing. Now, when you see a number like this, negative 14.3, the big question that's still out there is, are we dealing with good data being bullish, or is it still negative data, bad data being bullish? In other words, what's going to compel the Federal Reserve to act sooner? It's still bad data, negative data. Data suggests the consumer is slowing down, or manufacturing in this case is slowing down. Is keeping rates higher for longer actually damaging? Bonds have been saying that for months. Bonds are absolutely saying, look, Federal Reserve, we know you're going to cut rates, whether we get it in June, July, September, whatever it is, whichever meeting you decide to do it at, we know they're coming, but you're taking too darn long. And that's a lot of times what bond yields will be communicating. And that's exactly what we're seeing with the sort of bearish chop on ZB, the long bond. Ultimately, we've got Williams speaking at 8:30. That's done. That's kind of everything's in the rearview mirror, which is great. Anything that we'd be really concerned about. IMF meetings are starting, but those aren't really needle movers and significant needle movers anymore for equities. Really never were. Even for currencies, not so much. We do have daily tonight, but that's it. So maybe a rather smooth sailing session. We'll see what happens. So what are we inheriting this morning? Bad data is good. All right. And so take a peek at what we've got here on the 5-minute chart. I'm going to open this up just a little bit. And the reason we want to look at that 5-minute is it gives us a much closer look at what happened at each one of those events. Who spoke when? What was the outcome? What data did we get when? What was the outcome? So it's less about that number. I mean, frankly, I don't look at the calendar and I don't look at the result when I'm looking at this data. But for the most part, I am looking at time. What time is that data hitting the airwaves? What time is that data hitting the algos and hitting the market, hitting trading participants? And you'll see that crazy wick. But nonetheless, ultimately, the outcome is up. Even when we did top tier outlook yesterday, our 6 p.m. show on Sundays, that was already showing quite a bit of resiliency in the indices. And I will tell you, all my cards on the table, we've got a long position in the NASDAQ that with any nice follow through between, look, now and 9:30 might as well be a year long. It matters where we are at 9:30. We'll see where we are in 25 minutes, but we've got that long position in the NAS as we kick off the week. That was something we took on Friday and into the weekend. So, Rag, are you bullish? Doesn't matter what I say, only matters what I do. And yes, I am bullish. All right, so that's the long position. As always, gang, if you have any questions, feel free to type them in. So take a nice dramatic sip of coffee. That is good. All right, we are taking a look at the NAS. Let's jump on over to the bonds. I mentioned bonds earlier. And when we take a look at bonds, we'll take a look at gold as well. This year, it looks like bonds are in a bad mood, right? And haven't we heard, oh gosh, If the bond market is indicating higher yields by moving lower, isn't that bearish for equities? No. You're right. How many, and if you want to know, okay, Rock, how can you say no? Just because it's repeated a lot doesn't make it true. The inverse correlation has nothing to do with a direct relationship. Is it a negative correlation? It really isn't. The connective thread, the glue, if you will, is monetary policy. When the Federal Reserve favors lower rates and more accommodation, stocks love it. And bonds will then reflect that in lower yields, which is the uptrend on, say, ZB or the TLT ETF. Well, why aren't bonds higher? We have to go back a little bit to see when bonds responded to looking ahead to lower rates. And that was back in October. That was back in Q4 of 2023. That was when bonds said, okay, if we look ahead about 6 months at least, are we going to start to see the Federal Reserve favoring lower rates? And they like, bond traders, the bond market likes a front run by about 6 months. And you'll see that there. Now, since it's taken longer, the Federal Reserve just can't get their act together. Just get the messaging out there. It's been a mess. And you can see how bonds are sort of reflecting. You're taking too long and we still don't have clarity. That's all. That's all. Now, where there is clarity in terms of yields, gold. Gold never has, never was a flight to safety. Even though, again, just because something's repeated doesn't make it true. Gold never has been a flight to safety thing. It's really not. Sometimes you'll see, again, dollar, gold, sometimes bonds bought in times of stress. But that's really, the flow's got to come out of somewhere. If traders and investors don't want to be in stocks, where are they going to park their capital? So really, it's a choice. Now, gold moves based on something called real yields or real interest rates. Real yields are basically the nominal yield of the shorter end of the yield curve. So think 1 year, 2 year, 1 to 3 year, 1 to 3 year bond. Take that nominal yield, subtract the rate of inflation. When that narrows, gold goes up. That's it. So when we have that, relationship of real yields being inverse to gold, then we have really a lot of strength in gold. And we've seen that really clearly. So as uncertain as the longer end of the yield curve is in bonds, here's a bottom line. Rag, do I need to know all this? Not really. Not really. Because you can look at your charts and say, is there a trend on TLT? Is there a trend on GLD? Or is there a trend somewhere else? If you seek out the trends, what every chartist believes, whether they know it or not, is that everything they know and everything they don't know is already factored into price. And believe me, there'll be plenty of things we don't know. So whatever we know, whatever we don't know, factored into price, factored into volume, factored into volatility. And so ultimately, if we're looking at focusing on where the probability is for follow through, it's gold. Bonds are telling us a story, but it doesn't mean bonds are tradable or that it's the best place to look. And speaking of good places to look, let's take a peek at crude oil. Is crude oil still in a trend? This would be the USO ETF. This would also map to places like the XLE ETF, which is Exxon and Chevron. This would map to the OIH ETF, Oil Services, Schlumberger, Halliburton, and also Oil and Gas Explorers, the XOP. So as crude moves higher, when that commodity moves, just like gold miners, as many of you have noticed, are moving as gold moves higher, as crude oil moves higher, it's going to take the explorers, the energy sector, and the services with it, and it has. Do we want to be bullish crude? Absolutely. Would we like to buy USO on a dip? 100%. Where? Daily price movement range. Let's use the volatility of the current environment, which has been pretty normal for as bonkers as the broader averages have been, pushing the first and second standard deviation of historical volatility. For as bonkers as those have been, yes, technical term, crude's pretty organized. Crude's operating within its 68% probability. It's not way up at red line as the equities are, the indices are right now. So we absolutely want to focus on crude, not just USO, but those oil stocks too. And by the way, yes, as gold has continued and really organized, GDX, the miners, are absolutely in play as well. All right. So next up is a question on China. Okay, so there's two ways we can look at China: MCHI, FXI. I'll always favor where there's liquidity. I'll always, at the option strike level, I'll always favor where the whichever one of these ETFs has more volume. Right now, even though it's trying to organize into an uptrend where we would expect higher highs and higher lows, we're still below the 200. So the problem with FXI is we've been below the 200 since last August, arguably September, right in this area. We broke it back in August. We stayed below it. We retested it the first week of September. We have yet to get above that. So I'm going to presume the same thing's going to happen until it doesn't, until we get above those white dots. Think of it as the equator. Are we in the bearish hemisphere or are we in the bullish hemisphere? We're in the bearish hemisphere still. So again, if I'm thinking about where I'm going to put my capital to work, there's two things I can think about. With FXI, what I'm wondering is, hey, is it worth maybe looking at the weekly? Oh, no, it's not. So, those are questions that I'll ask. Is there another time frame that might have better structure? Maybe it's a 1 hour. Maybe those swings need to be of shorter time horizon, not a longer term time horizon. And we can look at a 1 hour. That's another thing we can do in terms of FXI. So thanks for the question. All right. Sachin says, good morning. Good morning, Sachin. There was a lot to take in from the class. I sure hope so, right? That was a 4 hour, jacked into the matrix where, I want everyone to sort of wake up like Neo did from the Matrix. I'm trying to find my favorite little Matrix image. Where is Neo? Where he wakes up and he knows Kung Fu. Yeah. So I definitely want that for everybody. There you go. There we go. Yeah, exactly. So, or maybe Bradley Cooper and Limitless is a better, the class was some NZT. Who's seen that movie? He takes a clear little pill. Yeah. So there's a lot to take in. So luckily it's recorded. I'll get the slides to you all probably by tomorrow, and everyone can review that. Of course, we have our bonus session coming up today at 3:00. If you haven't joined already, you absolutely can. If you go to toptierproclass.com, you can still join us, check out the class replay, get the resources and so forth that come with the class. Of course, the Top Tier Pro indicators. And you can join us for the bonus session at 3:00. During the bonus session, we're going to throw some more really practical ideas out there for you to consider in terms of how do I use my trading platform as my trading partner. We've got, look, Luke had R2, right? Luke had R2D2. We have our trading platform. What that allows us to do is say, look, I'm still at the helm of this X-Wing fighter, but I need some help. I need a second set of eyes. And that's where our platforms, our trading platforms, Thinkorswim, TradingView, can help us track things while we're off looking for more opportunity. So it's like telling someone in your office here, hey, could you keep an eye on FXI if it breaks to 200? It might be next week. It might be next month, but it will stay vigilant, right? Waiting for that moment and then alert you when it does. And those are things we can do. So whether they be alerts for entries, exits, certain conditions being met, whether that be alert for a trigger, whether that be an alert for the underlying premium value to have reached a certain threshold, like a break even or a stop loss, those are things we can ask our platforms to track for us. And then, oh yeah, it's even better. Not just our desktops, but these little things too, right? This is gonna light up when those circumstances are hit because I've got those platforms running on my little EMF device. All right, EMF emitters. All right, so that's basically what we're going to be diving into. How do we use technology to our advantage? Because we know there's a lot of things technology is doing that sometimes makes the market more volatile or difficult. Now you can fight technology with technology. All right, XLE on a 5-minute chart. I won't. On a 5-minute, I won't look at XLE quite yet, Anthony. On a 5-minute, let's let the bell ring, right? XLE pre-market might be moving clearly, but after 9:30, that's where the volume and attention and volatility and participation kicks in. And so I'll wait for that. Now, overall, XLE is definitely something I want to buy. I will wait to see where our daily price movement ranges plot. We had a higher than normal historical volatility on Friday. We really want to see that come back into that 68% probability. So, all right, Rog, what are you talking about when you say that we're exceeding historical probability? Well, we can track that with the daily price movement range. So if we see here, here's your first and second standard deviation of historical volatility. Here is your first and second standard deviation of historical volatility. So not only do we take it to the upside, the resistance side, we also took it down to support. So this is an outside the normal behavior. Look at how much, for the most part, we've been trading inside the DPMRs. That's the way it should be. We tag one end or the other of it, and that gives us opportunity, right? But when we're breaking both ends of it, that means that something abnormal is going on. And for all we know, XLE was already responding to some of the whispers of the geopolitical strife that we saw over the weekend, all the stressors that were playing out Saturday, Sunday. Friday, you might have a lot of traders running out ahead of that narrative on the possibility of those things. It does seem a lot of that's being shaken off right now. And yes, there were a lot of whispers about that. So, Rog, what if we go into a weekend and we hear these things could be possible and we know that markets are closed on Saturday or Sunday? There's a reason I went into NQ and not ES. NASDAQ is tech. Dow is going to be more susceptible to usually a lot of geopolitical stress. So will the S&P based on exposure to things like industrials and energy. NASDAQ, not as much. Not to mention, even if you didn't know that, take a look. S&P plotted a red top tier candle on Friday. NASDAQ did not. So your relative performance favors a long position in NASDAQ, in the tech. So I'll wait to see what we get, Anthony, at 9:30, and then we'll see what we can work with in terms of intraday and whether or not that is indeed the relative outperformer for us this morning, because I'm still going to compare XLE, not only to crude, but I'm still going to compare XLE to all the other sectors that we have and ask myself, is this a morning, a day, a session where we have focus on XLE, or is it going to be XLU, or is it going to be tech? Is it going to be more a risk appetite kind of environment? So I won't know that till the bell. And even then, I wait about 5 to 10 minutes to let that flow hit, and then we go from there. Okay, it seems the market keyed off bad manufacturing data this morning. Retail was hot. Does the market tend to favor one? So here's what's cool, Matt. I don't need to guess. I'll look at price action. So the question is, does the market tend to favor one over the other? And we can't just say yes, because remember, retail was a little good. Manufacturing was really bad. Negative 14.1, I think we got on the Empire State number. So the degree to which it misses matters. That will be some of the intensity. But at the end of the day, my friend, we're up. So there's our answer, right? So great question. Thank you, Matt. JP asked, with JP Morgan dropping into earnings, should other similar XLXF stocks be avoided? Yes. So if you've checked out, the Trish Boss has posted a number of times over the years my 642 window into earnings. No, I do not play earnings. I don't hate my money. I don't play that binary game of are they going to miss or are they going to beat. We like that window about 6 to 2 weeks before earnings to put in position size, to put in some trades based on whether or not we anticipate a rally into earnings. And financials did largely rally into earnings. As far as earnings itself, I leave it alone until the dust settles. And that's where I'll look at it. So yes, any of the financials that are still waiting on their earnings release, I will wait. And by the way, XLF is not even a relative performer anymore. So this was something we talked quite a bit about in the top tier outlook yesterday. And we'll talk about it again in the top tier newsletter that goes out to our Sector Secrets Mastery members and those of you that are subscribers to it. We don't have XLF, really in the top 4 or 5 in terms of the last month of normalized performance. This is not the environment where financials are shining at all. In fact, the last month is a negative 1.18 relative performance. Well, we have GDX at 12%. Why are we focusing on gold? Why are we focusing on energy? Why are we focusing on oil services and miners? Take a look at this list. That's your top 4 outperformers as of the last 1 month. So even if XLF was somewhat interesting, the normalized performance tells me that's not necessarily, and it has been telling us that for a while, that's not necessarily where the relative performance and the follow through, the continuation that pays us, right? That's not where it's at right now. All right, gang, as always, thank you so much for joining us for charts and giant mugs of coffee. I'll see you tomorrow, same time, same station. Be good to each other.